Every single grand hotel you've ever admired, whether it's a slick city boutique or a huge sprawling resort, didn't start with a single brick. It started with a blueprint, but not the kind you're thinking of. It started with a financial one. Today, we're going to dissect that exact blueprint to really understand the architecture of capital that turns a vision into a stunning reality. Hello, and a very warm welcome. I'll be your guide as we navigate the, let's be honest, sometimes complex world of hotel finance. I'll be bringing in insights straight from modern hospitality operations. I'm especially pleased to welcome all of you, the students of Europe Hotel School, as we dive into the skills that will shape your future in this incredible industry. All right, so here's our game plan for today. We're going to start with the developer's biggest hurdle. How do you turn a great idea into actual funding? Then we'll break down the two core pillars of that funding. We'll also look at the project through a bank's eyes, understand who gets paid first when the money starts coming in, and finally, we'll tie it all together with the ultimate goal, building a financial structure that can weather any storm. So, every great hotel starts as an idea, right? A really detailed plan full of promising projections. But the real test, the true challenge, is turning that potential into a physical reality. This is always the first and, frankly, often the most difficult step of the entire journey. And that, right there, is the heart of it. A feasibility study can look fantastic, showing excellent potential returns on paper. But let's be real. Without securing the capital, that paper profit is just that, a concept. It's the actual cash that builds hotels, and a developer's number one job is to go out and find it. Okay, so where does all this cash come from? Well, it's not magic. The entire financial structure of a hotel development rests on two incredibly powerful pillars, equity and debt. And believe me, understanding how these two work together is absolutely fundamental to all of this. First up, we've got equity. Now, the easiest way to think about this is as the developer's skin in the game. It's their own money, or money they've raised from private partners. It's called first loss for a very simple reason. If the project gets into financial trouble, this is the first pot of money that gets lost. It's definitely the highest risk, but, and this is key, it also comes with the potential for the highest reward. And the second pillar is debt. This is usually the biggest chunk of the funding, and it comes from a bank or another financial institution. Now, critically, this loan is secured by the asset, the hotel itself. What that means is, if the developer can't pay back the loan, the bank has a direct claim on the physical property. This, of course, dramatically reduces the bank's risk. Now, let's put some numbers to this. This chart shows a pretty typical loan-to-cost ratio. You can see banks will generally fund about 60 to 70% of a project. That's the debt. This means the developer has to come up with the other 30 to 40% in equity. And for hotels, that equity piece is often on the higher end compared to, say, an office building. Why? Well, because a hotel isn't just a building, it's a living, breathing, operating business with payroll, marketing, and daily revenue goals, and all the risk that comes with that. So banks want to see that the developer is seriously invested in making it a success. This slide just lays it out perfectly. It's all about a fundamental trade-off. For the developer, they put their equity on the line first. That's the high-risk part. But the reward? They get an ownership stake and all the potential upside. The bank, on the other hand, takes way less risk because their loan is backed by the building itself. But the trade-off for that safety is that their return is capped. They just get their fixed interest payments no matter how wildly successful the hotel becomes. So, we get the two pillars, but how on earth does a developer convince a bank to hand over that 60 or 70%? Well, it all comes down to one incredibly detailed financial document, the pro forma. This is the blueprint that proves to the bank that this project is a solid, profitable investment for them. And this is that document, the developer's pro forma. It's so much more than a budget. Think of it as the financial story of the hotel. It projects all the revenues, it details every single expense, and it maps out a super clear path to profitability, showing the bank exactly how their loan is going to be paid back over time. And this table here illustrates a core piece of that pro forma. The sources and uses table. Really, it's an exercise in complete transparency. On one side, you list every single dollar coming into the project, the sources. On the other side, you account for every single dollar going out, the uses. And as you can see, they have to balance perfectly. This shows the bank that the developer has a solid plan for every last cent. Okay, so now we know where the money comes from. The next logical question is, what order does it get paid back in? This is what we call the capital stack, and it creates a really strict hierarchy of risk and repayment. It dictates the exact pecking order for everyone involved. So here's the crucial point. The bank, which provides what's called senior debt, always gets paid first. Their position is the most secure, no question. Below them, you might find secondary or mezzanine lenders. They take on a bit more risk for a higher return. And right at the very bottom, that's the equity investors. They get paid last, which is exactly why their money is called first loss.
But, what happens when getting that traditional bank loan is tough? Well, that's when savvy developers have to get creative. There are some really interesting alternative financing options out there, like special investor programs, government grants designed to boost tourism, or even these specialized CPACE loans that fund energy-efficient upgrades, which can add value to the property right from day one.
And all of this brings us to our final and honestly most important concept. All this complicated work, balancing equity and debt, building a detailed pro forma, structuring the capital stack, it all serves one ultimate purpose. This right here is the key takeaway. A beautiful hotel with a shaky financial foundation is just a liability waiting to happen. A developer's true success isn't just in the building itself, it's measured by their ability to construct a capital structure that's robust, stable, and resilient. It has to be able to withstand recessions, market shifts, and whatever unforeseen crisis comes next, all while still delivering value. So I'll leave you with this question to really think about. As a future leader in hospitality, how does a stable capital structure actually prepare a hotel for an unexpected economic downturn? Because understanding the answer to that is the difference between a project that just survives and one that truly thrives.